IonQ was trading near $17 1 year ago in March 2025. Then it surged to $83 by October 2025, which was a 388% increase. After that, it started falling, and now it is around $26, a 68% decline from its peak. So, in just 12 months, IonQ shareholders have been through a complete roller coaster ride. So what exactly is going on with IonQ? After a 68% decline, is this now a buy? What does the stock's history tell us? Or is there a deeper reason why investors should stay away? Well, in the quantum world, if you ask the qubit whether your stock will go up or down, it might just say both at the same time. Very helpful. Problem solved. Unfortunately for us, the real stock market does not follow quantum rules. So if we want a real answer, we have to look at the business. So what is IonQ? In the words of its CEO, IonQ is the largest publicly listed quantum company in history by any measure. Patents, revenue, PhDs, balance sheet, and market capitalization. Now, quantum computers are not better versions of normal computers, and they are definitely not here to replace your home laptop. For everyday tasks like Excel, YouTube, email, gaming, or web browsing, classical computers will likely remain the better choice far into the future. Quantum computers are more like highly specialized machines. For a few very hard problems, powerful quantum systems could eventually do in minutes or hours what might take classical systems an impractically long time. That is the real promise of quantum computing. The big opportunity is not replacing ordinary computing. It is in helping humanity solve some exceptionally hard problems in areas like drug discovery, new materials, defense sensing, secure communication, logistics optimization, finance, energy systems, cybersecurity, and other problems where the number of possible combinations becomes enormous. In this video, we will discuss IonQ's stock performance, its operations, financial analysis, and then future outlook and conclusion. I rounded off a few figures here just to make the pattern easier to understand. And honestly, the pattern is wild. If you look at the 5-year chart, IonQ was trading around 9, then ran up to 31 by November 2021. That was a 244% increase. Sounds exciting, right? But then it crashed to 3 by mid-2022. That was a 90% decline. Then the story repeated itself. By mid-2023, the stock climbed again to around 20, which was a 567% increase from that low. Then once again, it dropped back to around 6 by late 2023, a 70% decline. Then it surged to 50 at the start of 2025, which was a 733% increase. And again, it fell this time to around 17 by March 2025, a 66% decline. After that, it started another rally and went all the way to 80 by October 2025, which was a 388% increase. And now here we are again with the stock falling back to around 26, which is another 68% decline. And as we speak, that decline is still expanding. So what does all this tell us? Very simply, IonQ is the kind of stock that can make you feel like a genius in one phase and then give you a heart attack in the next. I mean, 60%, 70%, even 90% declines. These are brutal moves. But the chart is also telling us something else. Every time the stock gets crushed, after 1 year or so, it seems to find a new story, a new wave of excitement, a new reason for the market to dream again. And when that happens, the upside can be huge, often in the range of 300% to 500%, and sometimes even more. So if someone is looking at IonQ not as a long-term, sleep-well-at-night investment, but more as a trading opportunity, then maybe the real strategy is not to chase the hype when everybody is excited. Maybe the strategy is to wait until the stock is deeply beaten down, buy when sentiment is weak, and then wait for the next wave of optimism. If history is any guide, even targeting something like a 400% return may not sound crazy for a stock like this. Before moving forward, I would like to request you to help me achieve the 1,000 subscriber milestone. It would encourage me a lot to continue this work. Now, moving back, the company itself still suggests that its bigger innovation story may take until around 2030 to fully materialize. And until then, this stock may continue behaving exactly the way it has behaved so far. Highly choppy, highly speculative, and driven by cycles of excitement and disappointment. Right now, IonQ is trading in the 20s. And yes, analysts have put target prices somewhere around 35 to 50. But in my view, target prices alone are probably not enough. Unless IonQ delivers a quarterly report that clearly beats expectations or announces something strong enough to change the market's mood, I do not think sentiment by itself will be enough to push the stock meaningfully higher. So the real takeaway is this: IonQ may still be a trader's stock before it becomes an investor's stock. So why has IonQ been so choppy recently? A big part of the answer is sentiment. In January 2025, quantum stocks initially fell after NVIDIA CEO Jensen Huang said practical quantum use was likely 2 decades away. But later, that weakness reversed when Microsoft unveiled a new chip that suggested the technology might not be decades away. Then in October 2025, quantum stocks jumped after a report said the US government was discussing taking equity stakes in quantum firms in exchange for funding. So, what we are seeing is that investors are getting carried away by the technological excitement. People saw shares like Rigetti Computing go from around $1 to $58, which is valuation territory that resulted in price to be 1,000 times of sales. That's crazy. As a comparison, NVIDIA trades at around 50 times sales, D-Wave at around 170 times, and IonQ at around 71 times. So while IonQ may still not be cheap in any traditional sense, it is also not as stretched as some other quantum names. That is why valuation in quantum computing right now feels more like an art than a science. There's also been news flow adding excitement to the sector. JPMorgan Chase announced plans to invest up to $10 billion in strategically important sectors such as quantum computing. In September, IBM and HSBC announced that they had used quantum-based technologies to develop a new algorithmic bond trading platform. So this is a sector where sentiment can swing very quickly between fear and euphoria, and IonQ's stock price is reacting to that. IonQ said it would buy chipmaker SkyWater technology for about $1.8 billion in a deal that would bring semiconductor manufacturing in-house and help accelerate development of its next-generation quantum processors. The cash and stock deal would allow IonQ to secure its supply chain by taking control of chip production, which is particularly important as it scales up work for federal and defense customers. IonQ aims to begin testing its planned 200,000 qubit chips in 2028. SkyWater, a U.S. semiconductor foundry with operations in Minnesota, Florida, and Texas, would use those facilities as quantum production hubs for IonQ. The deal is expected to close in the second or third quarter of 2026, after which SkyWater would operate as a wholly owned subsidiary of IonQ. So strategically, this acquisition is not just about revenue. It is about control, manufacturing, supply chain security, and speed. Another reason the stock has remained under pressure is that it started falling after a short seller report from Wolfpack Research. The report alleged loss of essential defense contracts and claimed there were gaps in revenue. Wolfpack also argued that a large portion of revenue from 2022 to 24 came from defense-related contracts that may no longer continue. In a separate development, a law firm announced an inquiry into potential securities fraud allegations. Now, at this stage, those claims appear more interpretive than conclusive. But until earnings provide better transparency on revenue mix, backlog, and forward demand, the shares are likely to remain volatile. Despite the sell-off, some options traders have been creating bullish call spreads, suggesting they believe the sell-off may have gone too far. Institutional ownership also remains substantial, which may provide some support to the stock. On the shareholder side, the latest widely available holder tables based on December 31st, 2025 filings show institutional ownership of around 55.15%, with biggest shareholders being Vanguard, BlackRock, and Morgan Stanley. So although the stock is highly speculative, it is not some forgotten microcap story. Serious institutions are involved. IonQ, listed on NYSE under the ticker IonQ, describes itself as a leading quantum platform and merchant supplier, delivering integrated quantum solutions across computing, networking, sensing, and security. It is headquartered in College Park, Maryland, and operates across several U.S. states as well as Italy, South Korea, Sweden, Switzerland, Toronto, and the United Kingdom. The company says it is building fifth-generation machines that are 260 million times more powerful than its current fourth-generation systems. Its upcoming system, IonQ Tempo, is presented as the next step in a line of machines already helping partners such as Amazon Web Services, AstraZeneca and NVIDIA in drug discovery, materials science, financial modeling, logistics, cybersecurity, and defense. IonQ says its fourth-generation machine can convert a month of classical computational work into a day and a half, and future systems may eventually convert a year of classical work into a day. If that becomes commercially meaningful, The benefit may be not only time savings, but energy savings too. IonQ also says it wants to become the world's first full-stack quantum platform company, spanning quantum computing, networking, sensing, security, and merchant supply. Now, those are big phrases, so let us simplify them. Quantum computing is the core business of building and operating quantum computers to solve certain problems differently from classical computers. Potential uses include optimization, simulation, chemistry, materials science, some AI and machine learning tasks, and cryptography-related work. Quantum networking means connecting quantum systems so quantum information can be shared between devices or locations, essentially a quantum version of networking. Quantum sensing means using quantum effects to create highly sensitive measurement tools that could detect tiny changes in time, gravity, magnetic fields, motion, temperature, and location. Possible applications include defense, medical imaging, navigation, industrial measurement, and scientific research. Quantum security refers to protecting data and communications using quantum-related technologies, such as quantum-safe encryption, quantum key distribution, and defenses against future quantum-enabled cyber threats. Quantum merchant supply means IonQ wants to sell quantum-related hardware, components, systems, and enabling technology to outside customers and partners. And quantum platform means the company wants to become a foundational layer for a broader quantum ecosystem where different quantum products and services connect together. So the bigger operational picture is this. IonQ is not trying to be just one product. It is trying to build a full-stack quantum ecosystem company. Some senior people have left IonQ. Co-founder and Chief Science Officer Chris Monroe announced he was leaving in October 2023. Peter Chapman was replaced as CEO by Niccolo Di Masi in February 2025, then later stepped down as executive chair and left the board in August 2025. CFO Thomas Kramer was also replaced in September 2025. Amazon also disclosed a stake of about 854,207 IonQ shares worth roughly $36.7 million in mid-2025, and later reports suggested that position was gone, meaning Amazon had sold out. But filings do not tell us why Amazon sold. For a company like Amazon, a position like that may simply have been portfolio management or profit-taking. That does not automatically mean the technology is broken. Leadership changes are also not unusual in deep tech companies as they move from founder-led science toward commercial scaling. And importantly, Amazon selling shares is not the same as AWS abandoning IonQ because IonQ systems are still available on Amazon Break It. If there were serious concerns about IonQ's technology, one of the first things you might expect is for Amazon to stop working with them. That has not happened yet. IonQ says it achieved a landmark result by demonstrating 99.99% 2-qubit gate performance, which it describes as a world record, surpassing the previous 99.97% result achieved in 2024 by Oxford Ionics, now part of IonQ. So what does that mean? A quantum computer is built from qubits, and to do useful work, it must perform operations on them. One of the most important and difficult operations is the 2-qubit gate, where 2 qubits interact. IonQ says 99.99% fidelity means those operations are correct about 99.99% of the time, or wrong only around 0.01% of the time. IonQ says this is the first time anyone has crossed the 4 nines threshold. The second important part is how it achieved that result. According to the company, this was done without ground state cooling. In trapped ion systems, ions usually have to be cooled to an extremely quiet state before very accurate gates can be run, and that cooling has historically been a bottleneck. A simple analogy is writing tiny letters on paper while the desk is vibrating. Normally, you would wait for the desk to become still. IonQ is saying it found a way to write accurately, even before everything becomes perfectly still, which reduces time lost in preparation. The company also says it used electronic qubit control, or EQC. Instead of relying on more complex laser-based control, IonQ says this method uses precision electronics and integrates qubit control components onto classical semiconductor chips. The argument is that this should make future systems more manufacturable, more stable, and cheaper to scale. But one important caution, this does not mean IonQ has already built a fully useful, mass-market quantum computer. The result was achieved on R&D prototypes that the company says will form the basis for future systems. So this is a meaningful hardware milestone, but it is still a step on the roadmap, not the finish line. Now, before moving to the financial analysis section, just a quick disclaimer. This video is not financial advice. If we look at the latest results, the picture is fairly clear. Revenue growth is strong. Revenue rose from $43 million to $130 million, a 202% increase. That is clearly the strongest part of the financials. The company has scaled revenue quickly and become the first public quantum company to cross $100 million in GAAP revenue. There had been speculation that this growth was mainly acquisition-driven, but IonQ's CFO Inder Singh said 80% of the increase came from organic growth. Of the $130 million in revenue, 60% came from commercial customers, which suggests the business is expanding beyond government and defense, and 30% of sales were international. For 2026, the company is targeting $235 million in revenue, which would be around 80% growth over the prior year. And of course, companies sometimes guide conservatively. On top of that, IonQ now has around $3.3 billion of cash, so interest income may also help next year. Since 2026 should also include revenue from SkyWater, total revenue could potentially exceed $400 million. And with a full year of acquisition contribution in 2027, revenue could even cross $1 billion. If that happens, it could support the stock. But there is another side to the story. Operating loss and expenses were $763 million, roughly 5 times revenue. So this is still a company spending far more than it earns. Even the quarterly profit needs context. The company reported quarterly profit of $753 million, but that was mainly driven by a $950 million gain from changes in the fair value of warrant liabilities. Underneath that, operating loss was still $229 million. The expense base is also heavy. Research and development came in at $306 million, and general and administrative expenses were $245 million. On top of that, stock-based compensation rose to $312 million in 2025 versus $107 million in 2024. That is enormous relative to revenue, and it means dilution is a major part of the story. On the balance sheet, liquidity looks excellent. IonQ had $3.34 billion in cash and investments. Current assets were $2.5 billion versus current liabilities of $167 million, giving a current ratio of 15.5 times. So near-term liquidity risk appears very low. But some of that asset growth came from acquisitions. Goodwill rose to $2 billion and intangible assets to $767 million. Those figures make the balance sheet look larger, but if acquired businesses underperform, they could later face impairment charges. Warrant liabilities rose to $2.472 billion, up from $70.7 million. That is by far the biggest liability on the balance sheet. So when you see total liabilities of $2.7757 billion, it is important to understand that this is not traditional debt. The liability structure is dominated by warrants. That also explains why earnings can swing so sharply. Warrants are like long-dated options that allow holders to buy stock at a fixed price in the future. If the stock price rises, the warrants become more valuable and the company records a loss. If the stock falls, the warrants become less valuable and the company records a gain. So when IonQ reported a huge gain from warrant liabilities, it did not mean the business earned that money in cash. It mostly meant those obligations became less valuable on paper. Cash flow tells a similar story. Net cash used in operating activities in 2025 was $283.2 million, compared with $105.7 million in 2024. So even though revenue improved sharply, the business is still consuming a lot of cash operationally. Why does that matter? Because a company can survive accounting losses for a long time if cash burn is controlled. IonQ still has a large cash cushion, so survival is not the main issue right now. The real question is whether revenue growth can eventually outrun this very high operating expense base. It is also important to note that the big jump in cash did not come from business profits. It came mainly from raising about $3.3 billion through stock and warrant issuance. That gave IonQ time and flexibility, but it also shows the company is still relying on capital markets rather than internally generated cash. Around $1 billion of that cash is expected to go toward the SkyWater acquisition, while the rest will support research and operations. CEO Niccolo de Masi has also said the company does not plan further acquisitions for the time being and will focus more on organic growth in 2026. Another issue investors need to watch is dilution. Weighted average basic shares rose from about 213 million in 2024 to 280 million in 2025, and by the fourth quarter, basic shares were already around 346 million. That is a material increase. Why does that matter? Because even if the company grows, that growth is now spread across a much larger number of shares. As a shareholder, you are not just asking whether the business is becoming more valuable, you are also asking how much of that value belongs to each share. If dilution keeps rising, future growth may not translate as strongly into gains per share. So the financial conclusion is this: IonQ is well-funded but not financially mature. This is not the profile of a stable, established technology company. It is the profile of a high-growth, high-burn, capital-backed, acquisition-heavy deep tech company. The balance sheet says survival is not the problem. The income statement and cash flow statements say execution and operating discipline still are. So where does that leave us? For me, IonQ is one of those companies where the technology story is exciting, the market opportunity is large, and the volatility is impossible to ignore. But if someone is looking for a long-term investment, then one of the most important things to see is a company that is already profitable, or at least clearly moving toward profitability with improving discipline. That is not where IonQ is today. The second concern is competition. Even if quantum computing becomes commercially meaningful, how much room will smaller independent players really have if giants like IBM, Microsoft, Google, Apple, and others decide to push harder? These companies have deeper pockets and broader ecosystems and the ability to absorb losses for much longer. So even if IonQ succeeds technologically, investors still have to ask whether it becomes a dominant platform, gets boxed in by larger players, or eventually becomes an acquisition target. That is why at this stage, IonQ does not yet look like a classic long-term compounder. It still looks like a speculative deep tech company trying to prove that its science can turn into durable economics. Now, that does not mean the stock cannot work. If someone's intention is trading rather than long-term investing, then IonQ may actually be a very interesting stock to keep on the watch list. It has a beta of 2.6, meaning it is much more volatile than the broader market, and changes in sentiment are driving both strong rallies and painful sell-offs. So in my personal view, IonQ right now looks more like a sentiment-driven opportunity than a fundamentals-driven investment. The technology is promising, the vision is ambitious, and the balance sheet gives the company time. But until the business shows more consistent operating progress, lower burn, less dilution pressure, and a clearer path toward sustainable economics, this may remain a trader's stock before it becomes an investor's stock. If this kind of calm, detailed, step-by-step stock analysis helps you, then please subscribe to the channel. Also, let me know in the comments, do you see IonQ as a real long-term winner or just a speculative trading stock for now? Thank you for your time.